Let us start with AS5. So basically there are only 5 terms which you have to remember. First one is ordinary activity. It is simple that ordinary activity, any business activity which is related to the main operations. Okay. And what is extraordinary activity? What is extraordinary activity? Any activity other than ordinary activity. Okay. Then there is a question where you have to identify this is ordinary activity or is it is extraordinary activity. If it is in normal course of business, then it is ordinary activity. But it is non-recurring in nature in the business, then it is extraordinary activity. Okay, and so what is ordinary? I had compiled a list there where all the adjustment of ICAI has covered whatever the question asked by ICAI. So ordinary activity. If there is any change in method of depreciation, it is in the normal course of business, so it is an ordinary activity. If there is any effect or change in provision amount, if there is any effect or change in a provision amount, this is ordinary in course of business. Okay, so this is also ordinary activity. And receipt of government grant, if you are receiving any government grant, it is normal course of business. But if you are refunding any government grant, this is an extraordinary activity. Why extraordinary activity? Because it means you had violated any provisions, and violation of any provisions, it is not in the normal course of business. It is non-recurring in nature type of activity. Okay, so if government grant is refundable, then it is extraordinary activity. If receipt of government grant is ordinary activity. If any legislative changes, because this is an exceptional item, because if there is a legislative changes, because in today's world there is so much changes in law, so this is a normal course of business. So legislative changes is an ordinary activity. If you are writing down of inventory to NRV, it is a normal course of business. Okay, so it is an ordinary activity. If any legislative changes having retrospective effect, it means like you have to change from the whenever you have started applying the provision, and you have to correcting all the adjustment and retrospective effect, you have to take the retrospective effect. Okay, prospective means it from it for today to future, and retrospective it means today to the whatever we had done in past, we have to correct our past, and then we have to continue from the present. And prospective means we have to continue from today to future. Okay, an extraordinary item, if goods are destroyed due to fire and claim was received, it is an extraordinary activity. Okay, an effect and loss due to theft, it is also an extraordinary activity. If grant receivable as compensation for loss, if grant is received as compensation for loss, receipt of grant is ordinary activity, but grant receivable as compensation for loss, it is not in regular course of business. So this is extraordinary activity. If you are VRS payment to employee, voluntary time is payment to employees, this is also an extraordinary activity. Okay, so you will ask what will be the treatment if that ordinary activity separately head is available, like for employee benefit expenses there is a separate head is available in the P&L, then you have to show under such head. If no separate head is available, then write it under exceptional item, for example inventory from cost to NRV. Okay, and what will you have to do with the extraordinary item? For this, you have all extraordinary items should be separately disclosed in P&L. You don't have to combine with ordinary and extraordinary activity. Okay, and then prior period item. Prior period item means any income or expenses which arise in current year because we had done any error or omission of previous year. So any error or omission of previous year which is not in current year, that is our prior period item. Okay, like for example wrong depreciation charge, wrong treatment of operation lease as finance lease. So what will be the requirement as per AS5? So any prior period item non in current year shall be separately disclosed we have to disclose in P&L, so that its impact on current year profit can be shown. So there are some example where I say ask fuel surcharge billed last year but accounted current year. Fuel was surcharge bill of last year, but we had accounted this year. Okay, so this is a prior period item. Theft of cost cash or stock in previous year, like for example on 19 February we had our stock was stolen. Okay, and in April we had got to know that our stock was stolen by any like thief and whatever be. So it is prior period item because we have to check at that time, but we are getting in our current year. So this will be a prior period. Treating of operating lease as finance lease, it is wrongly capitalized in the books. So this is also a prior period item. We have to consider it as operating lease. Okay. We have to because there is separate treatment of finance lease or operating lease, and vice versa. It will be a prior period item. And applying wrong percentage of depreciation, it will also prior period item because you are applying wrong percentage of depreciation. Revenue expense treat it as capital expense. If I say fair value adjustment, if you are treating any revenue expenses as capital expenditure in past years, but you had get to know that you had done incorrect accounting treatment, then you are correcting it. So this is a prior period item. Change in accounting estimate. So, sorry, first we'll continue with change in accounting policy. Accounting policy means any method used to measure and record any asset liability like income and expenses. So, for example, in AS2 inventory cost, FIFO, weighted average retail price, if you are changing in AS3 DAG method, in DAG method, AS7 contract revenue as per percentage of completion method, PPE, cost model, revaluation model, AS11 P&L and para 46 treatment of exchange loss on LTF CMI, AS12 government grant, P&L immediately or is a deferred amortized over the multiple year, AS13 if which cost of market value which is lower, AS14 purchase method, net asset to be recorded fair value, AS16 borrowing cost capitalized to qualifying asset and or P&L, AS23 investment measured equity method, AS26 intangible asset measured cost or fair market value, AS29 to create a provision for any outflow or not to create provision. So these are all change in accounting policies. So what I say will ask change from cost model to revaluation model, AS10. Okay, so this will change the accounting policy. Earlier we used to make provision, but now we decided not to make any provision or vice versa. If you are like if you are not making provision for this is changing your accounting policy. But if you are introducing any new policy like from this year we are starting paying bonus to the employer. So introduction of new policy is not a change in accounting policy. Remember this or write it down because I am not right here. So if your introduction of new accounting policy is not a change in accounting policy. Change in accounting as well change in method of depreciation. So what is change in like accounting estimate while measuring any asset? If we do not have any accurate data or information that we have to take certain assumption of some degree of estimation, then what I say, what requirement of AS5 in this? So if there is any change in accounting estimate, it shall be disclosed separately in financial statement. What will be the impact? Impact of accounting estimate will be prospective. Like in change of method of depreciation, change in accounting estimate. Retrospective, if there is any retrospective effect. If making changes in previous year financial statement, because changing accounting policy can be retrospective, but changing accounting estimate is like prospective. So if there is any change in method of depreciation, it is changing accounting estimate. Change is provision of staff welfare. It is also changing accounting welfare. But if you are introducing any new, so it is not it will not cover AS5. Change in warranty provision of bad debt or provision, it is also changing accounting estimate. Actual bad debt more than provision. If our actual bad debt is more than our provision made for bad debt, it is changing accounting estimate because we had made incorrect provisions. Okay, if there is any change in useful life of asset. Okay, if most important, if there is any change in management decision to pay pension, it is not a change in accounting policy. Most important. Okay, so I write it down separately. So this is not an change in accounting policy. I hope it will be so helpful for you guys. AS5 is completed, and whatever I had explained, like you have to disclose this, write it down because otherwise this video will be so long. Okay, thank you so much, guys.